Understanding money and investments in simple terms. Let's break down some important concepts in a way that's easy to grasp. Net present value (NPV) is like looking into the future and figuring out how much a project will add to a company's value. It considers all the money that will come in over time, but it also thinks about the fact that money tomorrow isn't worth as much as money today. The tricky part is estimating how much it costs to get money today. Time value of money. NPV understands that money today is more valuable than the same amount in the future. It adjusts future money to today's standards for fair comparisons. Value added. NPV tells you how much your project adds to your company's value. If NPV says $15,000, it means your project adds $15,000 to your company's value today. Considers risk. NPV thinks about risks by using a required rate of return. It knows that cash coming in sooner is better than in the distant future. Net present value disadvantages might not always show the full picture, especially when comparing different-sized projects, and estimating project cost can be tricky. What indicates to a firm that a project will increase shareholder wealth? The net present value is positive. The NPV is an estimate of the dollar amount that would be added to the firm's value as a result of the investment. What part of the NPV calculation is very important but difficult to estimate? The cost of capital is affected by several things, such as different capital structures, timing of cash flows, and investment potential, which makes it difficult to calculate. An inaccurate prediction of the cost of capital may cause a firm to miss out on good projects or accept bad projects. What is an advantage of using the NPV method? It calculates the dollar value that would be added to the firm by doing the project. What is a disadvantage of using the NPV method? It is not an effective way to compare projects of different sizes. NPV should not be used to compare projects of different sizes. Internal rate of return is like the percentage return on a project investment. It's handy because it makes the NPV of a project equal to 0. Advantages of internal rate of return is nice and simple, considering time and all the money, without bothering about the cost of getting money today. Disadvantages of internal rate of return, however, it doesn't care about how much value you actually get. It struggles when comparing mutually exclusive projects or those with unconventional cash flows. Suppose Alice is trying to explain to her friend, who knows nothing about the time value of money, why she should invest in Alice's new company. Which method of valuation should Alice use to convince her friend to invest? Internal rate of return, IRR. The IRR is easy to interpret, which makes it ideal for communicating the potential of an investment decision. Which NPV value indicates that the IRR has been reached? The IRR is the rate of return that makes the NPV of a project equal to 0. Why is the IRR a poor valuation method for a project with unconventional cash flows? There are multiple sign changes in the calculation resulting in multiple IRRs, and it is impossible to tell which IRR is the correct one. Projects with unconventional cash flows must be valued using NPV. A company called Bobby's Books is considering purchasing a new bookbinding machine. The company calculates the hurdle rate of the project to be 9% and the IRR to be 11%. Should the company purchase the bookbinding machine? Yes, because the IRR exceeds the cost of capital. When the IRR of a project is greater than the hurdle rate, the required rate of return, or cost of capital, it indicates that the company should accept the project. Profitability index is like comparing benefits to costs, helpful when choosing between projects, especially with a tight budget. Advantage of profitability index is great for ranking projects when money is limited. Disadvantages of profitability index like NPV and IRR. PI struggles with figuring out the cost of getting money today and doesn't work well with mutually exclusive projects. Which capital investment evaluation method is presented as a ratio? Profitability index, PI. The PI is the ratio of discounted benefits to discounted costs. How does the PI aid in interpretation of the NPV? It gives an idea of the return generated by a project. The PI scales different-sized projects so that their returns are comparable. Should a firm accept a project that has a PI of 0.8? Why? No, because the project would be generating cash inflows that are 20% short of the initial investment. As a rule, firms should accept only projects that have a PI greater than 1. You calculate the PI of a project to be 1 but realize that some aspect of your calculation was incorrect and needs to be adjusted. Which adjustment to the PI estimation should cause you to reject the project? The cost of capital was underestimated, so you adjust the cost of capital to be higher. Increasing the cost of capital decreases the PI. Therefore, the new PI will be less than 1, and you should reject the project. Bonds. Think of bonds as loans companies take, promising to repay borrowed money, plus extra, over time. Stocks are like owning a piece of a company. If the company does well, you might get some money, dividends, and even a say in important decisions, voting rights. Capital investment. This is when a company gathers money to invest in big projects for the long term, all in the quest to make shareholders happy. Why might a firm prefer to raise capital through stocks instead of bonds? Stocks do not require the firm to repay the par value to investors. Stocks are shares of ownership in a firm, so the value of the stock is not required to be returned to investors. An investor just purchased a bond for $973 that has a par value of $1,000. What type of bond is this? A discount bond. When the market price is less than the par price of a bond, you know that the YTM is currently higher than the coupon rate of that particular bond, so it is being sold at a discount. In what way is preferred stock different from bonds? Companies are allowed to skip payments to preferred stockholders but not to bondholders. If companies skipped bond payments, they would go into default. Companies can skip payments for preferred stock. However, by skipping these payments, companies are not able to pay common stockholders and must pay dividends in arrears at some point. Why might a firm seek capital investment? To purchase long-term assets for future growth. Firms need funding for projects that will increase shareholder wealth in the future.